Hey everyone, so today I'm going to discuss about top 10 investment options available for Indian investors. So the fact is that most investors want to make investments in such a way that they get sky high returns as quickly as possible without the risk of losing principal money. This is the reason why many are always on the lookout for top investment plans where they can double their money in few months or years with little or no risk at all. But a high return, low risk combination in an investment product unfortunately does not exist. In reality, risk and returns are directly related, they go hand in hand. That is, the higher the returns, higher the risk, and vice versa. So, while selecting an investment avenue, you have to match your own risk profile with the associated risks of the product before investing. There are some investments that carry high risk but have the potential to generate higher inflation adjusted returns than other asset classes in the long term, while some investments come with low risk and therefore lower returns. But nonetheless, here's a look at 10 investment avenues that Indians can look at while saving for financial goals. Number one is directly equity. So, that is investing in stocks. While investing in stocks might not be everyone's cup of tea as it's a volatile asset class and there is no guarantee on returns, further, not only is it difficult to pick the right stock, timing your entry and exit is also not easy. The only silver lining, however, is that over long periods, equity has been able to deliver higher than inflation adjusted returns compared to all other asset classes. To invest directly in equity, one needs to open a demat account. Banks also allow opening of a 3-in-1 account. Number two option is equity mutual funds. So, equity mutual fund schemes predominantly invest in equity stocks. As per current SEBI regulations, an equity mutual fund scheme must invest at least 65% of its assets in equity and equity related instruments. An equity fund can be actively managed or passively managed. In an actively traded fund, the returns are largely dependent on a fund manager's ability to generate returns. Index funds and exchange traded funds are passively managed and these track the underlying index. Equity schemes are categorized according to market capitalization of the sectors in which they invest, and they're also categorized by whether they're domestic, that is, investing in stocks of only Indian companies, or international, that is, investing in stocks of overseas companies. Number third option available for Indian investors is debt mutual funds. Debt mutual fund schemes are suitable for investors who want steady returns. They are less volatile and hence considered less risky compared to equity funds. However, these mutual funds are not totally risk free. They carry risks such as interest rate risk and credit risk. Therefore, investors should study the related risks before investing. Number four is a popular investment option offered by the Government of India, which is National Pension System or NPS. It is a long term retirement focused investment product managed by the Pension Fund Regulatory and Development Authority or PFRDA. The minimum annual contribution for an NPS Tier 1 account to remain active has been reduced from Rs 6,000 to Rs 1,000. It is a mix of equity, fixed deposits, corporate bonds, liquid funds, and government funds, among others. Based on your risk appetite, you can decide how much of your money can be invested in equities through NPS. Number five is Public Provident Fund or PPF. Since PPF has a long tenure of 15 years, the impact of compounding of tax-free interest is huge, especially in the later years. Further, since the interest rate earned and principal invested is backed by sovereign guarantee, it makes it a safe investment. And also, interest rate on PPF is reviewed every quarter by the government. Sixth is another very popular option, which is bank fixed deposit or FD. Bank fixed deposit is considered comparatively safer than equity or mutual funds choice for investing in India. Under the Deposit Insurance and Credit Guarantee Corporation rules, each depositor in a bank is insured up to a maximum of Rs 5 lakhs with effect from February 4, 2020 for both principal and interest amount. Number seven is Senior Citizen Savings Scheme. Probably the first choice of most retirees, right? As the name suggests, only senior citizens or early retirees can invest in this scheme, and it can be availed from a post office or a bank by anyone above 60. It Senior citizen scheme usually has a 5-year tenure, which can be further extended by 3 years once the scheme matures. The upper investment limit is rupees 15 lakhs, and one may open more than one account. The interest rate is payable quarterly and is fully taxable. Also remember, the interest rate on the scheme is subject to review and revision every quarter. However, once the investment is made in the scheme, then the interest rate will remain the same till the maturity of the scheme. Senior citizen can claim deduction of up to rupees 50,000 in a financial year under section 80 TTB on the interest earned. Number 8 is Pradhan Mantri Vaya Vandana Yojana or PMVVY. It is also for senior citizens aged 60 years and above to provide them an assured return of 7.4% per annum. The scheme offers pension income payable monthly, quarterly, half yearly, or yearly as opted. The minimum pension amount is rupees 1000 per month and maximum is rupees 9250 per month. The maximum amount that can be invested in the scheme is rupees 15 lakhs. The tenure of the scheme is 10 years. The scheme is available till March 31st, 2023. At maturity, the investment amount is repaid to the senior citizen. In the event of death of senior citizen, the money will be paid to the nominee. Ninth is again one of the popular options, at least it was very popular till few years back, which is real estate. But I think the important thing is to remember is that the house that you live in is for self-consumption and should never be considered as an investment. If you do not intend to live in it, then the second property you buy can be your investment. The location of the property, I think, is the single most important factor that will determine the value of your property and also the rental that it can earn. Investments in real estate deliver returns in two ways: capital appreciation and rentals. However, unlike other asset classes, real estate is highly illiquid. The other big risk is with getting the necessary regulatory approvals, which has largely been addressed after coming of the real estate regulator. Number 10 is gold, the final one, everyone's favorite. Possessing gold in the form of jewelry has its own concerns such as safety and high cost. Then there is the making charges, which typically range between 6 to 14% of the cost of gold and may go as high as 25% in case of special designs. For those who would want to buy gold coins, there is still an option. Many banks sell gold coins nowadays. An alternate way of owning gold is via paper gold. Investment in paper gold is more cost effective and can be done through gold ETFs as well. Such investment happens on a stock exchange, that is NSE or BSE, with gold as the underlying asset. Investing in sovereign gold bonds is another option to own paper gold. An investor can also invest via gold mutual funds. So hope this information was useful. Now please decide which among these you would like to consider for your investment based on your risk appetite and your target by when you want to achieve these financial goals. Thanks for watching.